Okay, in today's video, I'm gonna tell you how to set up TradingView. I'm going to teach you how to learn the time frames and the candlesticks of trading. I'm going to tell you what you're gonna do to set up the TradingView and to set up your account. So first thing you do, you type in TradingView. Simple. You press this, sign in, make an account. Bada bing, bada boom. Very simple. After you make an account, you click products, you click super charts, you're in the charts. What you're gonna do is delete every single one on the right. It's gonna click that little box, the little trash can, you click everything and you're done. Next, you click the plus, add symbol. You're gonna type in MNQ. Click the American flag. You're gonna press it. It's gonna be like an add button right there. Then you click MES. You click the plus. Okay, now you have MNQ. MES, very simple. MNQ means NASDAQ. MES means S&P 500, okay? Now what you're gonna do is you're gonna click on MNQ, the time frames, and this is very basic. On the right side, there's the stocks, the price, whatever. This, you can move up and down, very simple. And your scroll wheel, you can move like this, up and down, whatever. You can mess with it, do whatever you want. Left side are all your tools. Top side, you can search up the stock or whatever you want. The times mean the time frames of the candlesticks. Indicators mean indicators. Undo and reverse. Very, very simple. What you're gonna do is you're gonna click the trend lines right here. You're gonna start the trend line. Boom. You start it. Then you click right here. No, you don't. You click this one right here. You click the long position. You start the long position. You start the short position. Very simple. Then you're gonna click right here. You're gonna click the rectangle and boom, you start it. I click brush, went to rectangle. Now I have this toolbar right here. Remember that this is your toolbar. This is basically all you need. Move it around, move it around. Very simple. Click the time frame, click 4 hours. Just click 4 hours, just do it. Just do it because I said so, okay? Now there's a trading panel. That's what you're gonna focus on. Trading panel, you click that. These are all the brokers that you could trade with. You're usually going to trade with Trade-of-8 because that's what most brokers use. This is one right here. But what you're going to do, since you want to become profitable in 3 months, develop a strategy. You're not going to want to risk any money because you don't want to lose any money. Because if you do trade 3 months, you might learn quicker, but you're also going to lose quicker. And you might not learn while you're losing because you might get emotional, whatever. Aside that, anyways, you click paper trading. You have 100,000. Simple. You can move this up and down. What you want to do is click trade. This is how you set up the trading. Sell and buy. Very simple. You put sell, you're betting it's going to go down. You make money when it goes down. You lose money when it goes up. Simple. You click buy, you're betting it's going to go up. You make money when it goes up. You lose money when it goes down. Simple. Buy and sell. Market, limit, and stop. Market means right when you click buy, your order gets filled. Limit, you place it wherever you want. And once the price touches that point, that's when your order gets filled. What you're going to use is market. That's what you want to remember. And you're going to use 5 units and less. Take profit, stop loss. Very simple. You have the USD dollars right there. You're going to be wanting making 500 a day. Minimum. You're going to be want to lose. Your risk is going to be 250 USD. Simple. I'm going to click the limit since I can't take a trade at the moment. Limit. Here's an example. For 10, I put market order at 19,394. I click that. It says right there $9,000 I'm gonna make if it price reaches this point. I'm gonna lose 7,122 if it reaches this point. Very simple. And what you're gonna do is press the long position. You're gonna place your longs at that point, and then you're gonna place your stop loss at that point. Simple. But you're not going to want to lose that much. So you're going to move it like this. You click on it. You move it. You want to lose 250. You click 250. You want to lose 500. You lose 500. You want to make 2,000. You move it around. And then it's very simple. But on the market, it's going to say confirm. And you can press to confirm. Or make changes on this side. On the right side. But for now, since we're in limit, this is how it looks. You're in the 4-hour time frame. You're going to want to go to the 1 minute. Make it simple. Go on the 1 minute. Delete all that. Delete all that. Delete all that. Click the X to delete all that. So pretend I want to go longs right here. I like it. I want to go longs right there. Boom. My stop loss is gonna lose 242. That's what I want to lose. What I want to make, if I can find it, what I want to make is like 540. Very simple. What you do after that, before that, you place this. Place it at the exact points. So I got in right here and I got out right here if I win. If my trade is a winner. If I lose 242. And the long position, you're looking at these numbers and you're probably thinking what that means. Target right here, it says 52.75. What that means is points. So those are 52 points. Right here, stop loss 25 points. So to lose $242, you're down 25 points. To win, how much is it? $540. You win, you're making 52 points. What you want to do is make at least 40 points and lose 20 points. So always keep it 1 to 2. So you're risking 20 points to make 40 points. Right here, I'm risking 25 points to make about 52 points. That's a 1 to 2 risk to reward. Very simple. Same thing with sells, it's just the opposite. Delete all this, delete it all. I want to take profit, I want to stop loss. Okay, where am I at? I want to get in right there. I want to get in right there, right there, right there. Very, very, very simple. I put take profit, stop loss, market order. Everything's so simple. It's, you know, it's cakewalk now. It's cakewalk. You get in short right there. Now you press the short button. You press the target. Boom, right there. So if it goes up, you're losing 29 points. If it goes down, you're making 55 points. You're getting $570. You're risking $292. Very simple. That's how you use it. You just need to know that for now. And you're going to click market order. You're going to click take profit and stop loss. And don't get out until it hits one of those two. Don't get out early. Simple. Now that you know how to use the basics of TradingView and all the, you know, mechanics settings, what you're going to learn is time frames. So you're going to click the 4 hours right there, time frame. Scroll out, scroll out, scroll out. And you're going to learn time frames and candlesticks. First, what is the time frame? What does the time frames mean? What does 4 hour, 1 hour, 30 minute mean? What it basically means is each candlestick was formed in 4 hours for this time frame. Since I'm the 4 hour, every single candle, each specifically one, it took a total of 4 hours to make one candlestick. Same applies to everything. I go on the 15-minute time frame. Each one of these candles, one of them took 15 minutes to form. Very simple. That's all you need to know for now. Now, what is a candlestick? It's very simple. There's two parts of a candlestick. There's the body right here, the rectangle box, and there's the wick, the line right there. And there's a red candle and a green candle. Green candle, that means in that 15-minute time period, since we're in the 15-minute time frame, in that 15 minutes, it went up. Now, let's say we're using a green candle, for example, the body and the wick. So the open of the body, the low of the body of green candle, that's when it opened. When it closed was the top of the body. This is a body close and body open. So basically what that means is price open at the bottom of the body and it closed at the bottom, it closed at the top of the body during those 15-minute time period. The wicks, these lines, it's very simple. Just during that 15-minute time period, the lowest price it went to was right there on a green candle. The highest price point it went was right here. Okay, it's very simple, and there's the opposite for the red candles. So you see this red candle right there, instead of opening here, it opened at the top of the body and it closed at the bottom of the body. So price opened at the top of the body of this red candlestick, and during that 15-minute time period, once that 15-minute time period ended, it closed at the bottom of the body. And the wicks are the same with everything. The highest it went to during that 15-minute time period was up here, and the lowest was right there. Now that you know what candlesticks and time frames work, now we're gonna get a little deeper inside the strategies. So the first strategy is called a fair value gap. So you have 3 candles, 1, 2, and 3. You have the box, remember the box. The first candle, remember the wick, you press right there, and on the third candle, the bottom wick, you move the box for it to touch that. So this applies to any fair value gap, any color. The color doesn't matter, it's still going to be called a fair value gap. Now there's differences in strength and weaknesses in the colors. If it's all green, you know, fair value gap, if all 3 of the candles are green, I mean, it's better. If it's like this, might not be the best. But what it means is, once these 3-minute candles form and it creates a box, a gap between the first and the third candle, it creates a gap. What price tends to do is create it, and then it draws towards the gap. It's called a draw on liquidity. It goes up, it creates it, goes down into the fair value gap, and it goes back up. That's what usually happens with a fair value gap. That's what it does. Okay? Now let's say Alder, you know, let's say that doesn't happen. Okay? Let's say that fair value gap keeps going lower and lower and lower. Well, for that scenario, what happens when it goes reverse? Okay, here's an example of the inverse fair value gap. I mark out the fair value gap with my box right here. Now, what happened, Alder? It didn't go up. It was supposed to go up. That's what they do, right? Well, this one is called an inverse fair value gap. Instead of going up, instead of going towards and bouncing upwards, the green fair value gap, it went downwards. So instead of going up and instead of touching it and going up, it closed below right here. And what this means is price is gonna go lower for a bullish fair value gap. For bearish, I'm pretty sure you know this, or you don't. This is a bullish fair value gap. That means once it touches the gap, it's gonna go higher. But once it inverses, it's gonna go lower. That's a strategy. Very simple. And the opposite is for the different colors. So, for example, this is a bearish fair value gap. What that means is once it goes lowers, it creates the fair value gap. It touches it, that means it's gonna go lower. And if it doesn't go lower, if it inverses like this, it closes above that fair value gap, that means it's gonna go higher. Very simple. You see it went higher, but this is not price action you want to trade, and we'll get more into that. But for now, you know what a fair value gap is and an inverse fair value gap. It's very simple. Don't overcomplicate it. Just keep it simple and you're gonna make money. It's easy. It's easy. It's light work. You got it. Now for the second strategy, we're gonna go into highs and lows and liquidity. So what are highs and lows? Well, I'm literally saying the words. High and low. High, low. What is this? This is a high. That's a high. This? Well, that's a low. Highs and lows. Very simple. So this high is a high. What about this high? This is a high too, right? Yeah, it is. But it's just called a higher. No, it's called a lower high. Lower high right there. Lower high right here. Or you can also call this buy side liquidity. This is buy side liquidity, is external liquidity. This is internal liquidity. This is internal liquidity. This is external liquidity or sell side liquidity. Very simple. Very, very simple. Now this is a low, isn't it? That's a low, yeah. But it's called a higher low because it's higher than the previous low. Okay. What if, what do we say? Oh, this is a high too. Well, it's a lower high, yeah. But it creates another high. What does that mean? This high is higher than this high. Higher high. This one too. This one's a higher high too. Very simple. Just get the basic information. You don't have to go too much in depth. Just know that for now. Highs and lows are liquidity. Simple. This high, or that high, liquidity. Pretend above here, there's a lot of liquidity. At this high, there's a lot of liquidity. At this low, there's liquidity resting below the lows. Liquidity resting above the highs. That's liquidity. Liquidity is how fast you could get in and out of the stock, or currency or indice. It's how fast you could get in and out. Remember how liquid you are. You got cash, you got liquid. Simple. Right here, there's a lot of liquidity. People got in right here, it went up. People got back in, it went up, because that's where people get fast in and out. You go right here, not a lot of people can get fast in and out. It's harder. Just keep it like that. Keep that mindset. Now, that's liquidity. What do you do with liquidity? Well, liquidity, the market sets up a lot of traps. So some people see liquidity right here. They see this low right here. Pretend it goes lower and it creates a lower low. People think it's gonna keep going lower, but instead it takes that low and then it continues going higher. What is that called? Liquidity sweep. So for example, you see we're going lower high, and then it creates a lower low right here. People think it's gonna continue going lower, but instead of going lower, it goes higher. That's called liquidity sweep manipulation. Same thing with the opposite on the buy side, on the higher time frame, not on the higher time frames, on the higher parts of the market. This is the low. We create a liquidity sweep. People thought it was gonna go lower, instead it went up. Same thing if it's going higher. People think it's gonna go higher, and then it continues lower. It's called liquidity sweep. Liquidity. So let's say we see liquidity right here. We see this high right here. You see this high? Liquidity is resting right there. What do people see? People see it goes up and it takes it. People think it's gonna go higher. Instead, it's a trap. Liquidity swept. This liquidity got swept by this price action. What happens when it got swept and went lower? Same thing applies to the lows. These are the highs. These are the lows. If it happens to the lows, it sweeps this liquidity resting right here, and then it goes higher. Sometimes it runs it and it keeps going lower. But for now, our strategy we call liquidity sweeps. Now I'll let you know what liquidity is, or kind of understand what it is, because this is a very basic, very basic of the basics of the basic of the strategies. Just keep in mind what you want to know is that you need these confluences. You need the first confluence, the fair value gap. Second confluence, the SMT. These are all confluences. So pretend the fair value gap is the roof, the SMT, the walls. And then the next strategy is gonna be the foundation. You need all these components to take that trade to build that house. Same thing, it's very simple. Once you have all the confluence together, then you take that trade. But now that you know time frames, candlesticks, you know two to three basic strategies, the SMT, fair value gap, and inverse fair value gap, and you know a little bit more about liquidity and when to take the trade, or your bias of where the market's gonna head. For example, if you think the market's gonna head toward this liquidity, you're probably right. It headed toward this liquidity right there. It got touched. It didn't really get swept, but it got touched. Right when it got touched, this liquidity got all taken. This liquidity got taken, and then what happened? It went lower. Very simple. Liquidity got touched. You look for an entry right here with a fair value gap. Then you take that trade right there, and it goes lower. Very simple. Very simple. You know fair value gap. You know inverse fair value gap. Now you know liquidity. Now what I'm going to teach you is the SMT. This is the last strategy that you need to know. So for this strategy, I'm going to make it very simple. This high right here, and let's make this high right there. Okay, we're gonna add in the text SMT. This high is higher than this high. Can we agree? I mean, it's right in our faces. This high is lower than this high. Now this is where the S&P comes into play. So we have NASDAQ, we have S&P 500. These pairs are correlated. What that means is they move exactly the same. Now I already have it marked out, but this is the same time frame. Remember, the high was higher than this high. Instead, this high is lower than this high. What that means between the highs, if it creates its SMT divergence, it creates that means it's going to go lower. Does it mean you take the trade just because of that? It's just a confluence. It's just a building component to make you take that trade with the other components to build that house. So SMT, boom, boom. You have SMT, the upside. If it's the opposite side, so with the lows, per 10, this is NASDAQ per 10. This low was lower than this low. But on the S&P 500, it was like this. It was like that. This low was higher than this low. It was a higher low. But on the NASDAQ, there was a lower low. So what happens on that part, that means it's going to go higher. The SMT divergence as well. It's just the opposite side. It's very simple. I mean, this is basically all you need to know. You need to know the three basic trading strategies: liquidity, SMT, fair value gap / inverse fair value gaps. You wait for liquidity to get taken, and then you wait for an entry for fair value gap, and your confluence is because there's also SMT. Those are just basic components of taking a trade. And there's also another one where the higher the time frames, the better the move. Like if we see a 1 minute fair value gap, it might play out, it might not. But if we see a 1 hour fair value gap, that means it's more prone to actually work. So if we see a 4 hour fair value gap like this right here, that means it's probably gonna respect it. It's gonna draw towards it and it's gonna go lower like it did right there. That's an example of what happened. But there's a bunch of little 1 minutes. They created one of these. Instead of rejecting, it went straight to it. So understand that the higher the time frame, the bigger the move is probably going to be. And if you add that, the 1 hour fair value gap, with what I just showed you, that with the SMT and a smaller fair value gap and a liquidity sweep, like right here, boom, liquidity sweep. And for now, it wasn't right there, but pretend the 1 hour fair value gap was right here. If there's a 1 hour fair value gap, there's liquidity right here and it got swept. And then there is a 1 minute fair value gap right there for your entry. And there's a SMT. This is an A+ setup. Simple. A+ setup. You're going to take that trade 10 out of 10 times. That's what you're looking for in the market. That's what you're looking for. And then once you find that setup, that's when you take that trade. So now that you know how to set up TradingView, you know the basic strategies to take the trade. You know what's a fair value gap, an inverse fair value gap. You know what's liquidity. You know what's SMT. You know what's a liquidity sweep. Go ahead and start trading. What you're gonna want to do is for 7 days, I want you to make $1,000 off this paper account. Just keep trading, keep taking setups, keep doing all these things. Like right here, pretend I wanted to get shorts right there. I place my order right there. My stop loss at like 40 ticks. Take profit at 80 ticks. I mean, not 80 ticks, 80 points, and stop loss at 40 points. Let's see what happens. You probably make 500 or 1,000 depending on the units. But what you want to do is use 5 micros or less, because when you take on the Roll Live account or the challenge account, that's what you're going to be trading. You're going to want to trade 5 or less micros depending on the volatility of the market. If the market's moving super crazy, super up, or moving super low, for now just use 5 to 1 micros. And if you're risking, let's say 5 micros to make 40 to 60 points, you're probably going to make $500 if you put like 40 points. But if the market's moving really fast, use like 2 micros to make 80 points and to lose 40 points, and it's probably going to be the same amount of money. Depending on how the market's moving and depending on the stop loss, that's how you're going to want to trade. Okay? Very simple. For 7 days, just paper trade until you find your niche, until you find setups like these every single day and you understand them and it comes like butter. For now, these are the basics. Go in depth into the tutorials or the guides. Those explain more in depth into liquidity, more into inverse fair value gaps, more in depth into high time frame PD arrays, SMTs, and it goes more into depth, but for now these are the basics and this is what you're gonna do. Just 1 month of just paper trading and learning the strategies, and then once you learn all the strategies and you absorb everything and know what you're gonna do, then buy a challenge account and do the exact same thing you're doing for that month, except it's on a challenge account. You pass that challenge account the second month. It'll probably take you 2 weeks, a month, depends if you passed it or not. If that same month you pass it, you do the same thing with the live account. The live account, you start using 5 or less micros every single day, making 250 to 500 a day. You're making that every single day on the live account. Let's say for a week, you take 1 loss, you take 4 W's for 500 for 4 days. Technically it's 3, since that technically it's, no, it's 4. The 5th day you took a loss, whatever, 500, 1,000, 1,500, 2,000, a loss about 300. So 2,000 minus 300, you're making 1,700 a week. And that's just the starting point. If you become really, really good at it, you could be making 10,000 a day, 20,000 a day, 100,000 a day. It's very, very simple. If you want to come along with the journey with me of doing this, you're more than welcome. I know I'm going to make 10,000 a month regularly. It's not something to boast about. It's just something that's going to happen. But other than that, very, very simple guide. You could do whatever you want with this video. Go more into depth. I will be making probably other videos explaining the strategy, and because sometimes things like these happen, but you don't fully grasp the understanding of how to take a trade. And it's very, very simple. But now training video is done.